11 times earnings. And recently they spun off a company called Hillhaven. It's on the American Stock Exchange. Sells for $1.50. Typically you would think that a stock at $1.50 is close to going bankrupt, but this one has a chance. It even has a chance to grow old and maybe grow some silver hair as well.
You have to nurse it, though.
Exactly.
All righty. Now, if you're participating in the aging of America, and remember the alternative is worse, we'll try to help you become both older and wiser. So quick, before I become too senile to reply, send your wrinkled and retiring money questions to us here at Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. Now, before we meet tonight's special guest, it seems timely to take one of our periodic looks at how the Dow Jones Industrial Average really is doing when you take those reported figures and shake off the padding of inflation, which always makes the current numbers seem larger than they are. And we'll also see how the picture changes when you include the dividends on those stocks in answering that ever-perplexing question, how high the Dow? First, let's take a look at the official Dow, the one we talk about each week. Our chart begins in 1913 when the Dow was around 88. Its highest point ever came in July of this year, when the Dow closed just a quarter point shy of 3,000, and it's now resting at 2488.61. But when you wring out the effects of inflation and look at the Dow in constant 1913 value dollars, in other words, its real buying power, you find that the authentic all-time high was reached back in January 1966, that the Dow was lower in 1982 than it was in 1913, and that to set a real inflation-adjusted high this year, it would have to close at, get this, 4,084.97. But while you hold your breath waiting for that happy day, there's an important consolation prize. The missing ingredient in both the earlier measurements is that those Dow stocks paid dividends every year, and the real return of investors included those dividends. In a special calculation for this program by our friends at Media General starting in 1930, we find first that the Dow with dividends reinvested was actually more than 16 times as high as it looked at its peak this year, and is now up by a whopping 16,750% since 1930. And even on an inflation-adjusted basis, is ahead by more than 2,000%, which means it rose more than 3 times as fast as prices in general during those 6 decades. However you figure, though, the last 4 months have scarcely been beer and Skittles for investors in stocks. For some thoughts on the entertainment value of the next generations of investing, let's go over now and meet tonight's special guest, Alan B. Bond. Alan, welcome. We're delighted to have you with us.
Thank you, Lou.
Please have a seat. When Alan Bond was 10 years old, his mother, a school teacher, told him the family had $5,000 to invest in stocks, and he shared in the decision to buy General Motors and IBM, though his heart really was in Delta Airlines because it had just taken him to Disney World. From that promising beginning, he has become, at 29, a fast-rising professional investor who now manages about $90 million of other people's money as a portfolio manager for W.R. Lazard, which is the largest minority-owned investment firm in the country. And he is passing his interest on to the next generation by conducting seminars that teach inner-city children about the wonders of investing. Alan, before you joined Lazard last year, you were a standout performer for what I suppose could be called a majority-owned firm. Does pigmentation really matter when it comes to investing?
It really makes no difference. Our business is based on performance, and that's how we go about conducting it.
You've had a good performance, so tell us how you look at the market now.
Well, we've been cautiously optimistic. I mean, the way the market has behaved over the last few months, there have been certain issues that have certainly caused some attention. Earnings, the Middle East situation, the budget, the economy, the direction of interest rates. Because many of those have become resolved most recently, all but the Middle East, we're feeling a little bit more optimistic here. But because of the Middle East, we are somewhat cautious here.
As you heard, our panelists vary in their appraisal of 1991. What's your view of the economic outlook?
Well, we think that the economy does go through a period of sluggishness, but that we do get back on track. As we saw last week with the GNP number, that left us a little bit more comfortable, and we'd like to think that we're poised to improve from what seems to be certainly a difficult situation right now.
So you don't see a bad recession?
We don't see a terrible recession, although we do realize that we're in a situation that we haven't seen in a long time with the financial crisis, with the problems that we're having in the real estate industry, but somewhat optimistic.
What are some of the stocks you're buying these days?
Some of the things we're buying these days really revolve around the overall emphasis, looking for companies that have a diversification of both revenues and products. Some of them, such as Syntex in the drug area, Compaq in the technology area. We also have been very positive on the food sector, where we've used General Mills and CPC.
Why don't you talk, you've talked about 4 big companies. Why don't you go to each of them and tell us briefly what you like about them?
Well, specifically, our 2 favorites right now would be Compaq in the technology area. Compaq has just demonstrated with the recent quarter about 38% earnings growth. While we tend to emphasize large cap growth companies, that fits right into our criteria. Also, very strong financial condition, and the fact that 54% of their revenues come from overseas right now. We think of them as a global dominant player in the computer industry. When it comes to Syntex, true classic growth company, quality earnings. Earnings are going to grow about 50% over the next 3 years. The company has truly made the transition from a single product company and has now become a diversified player in the drug industry. A couple of blockbuster drugs down the pipeline, so we like what's coming in the R&D area. Then in the food segment, consistent with our theme, CPC probably has some of the best brand name recognition and also has very good presence around the globe in Asia, Latin America, and Europe.
So you're emphasizing some pretty strong international themes.
We are. We think that that's the best approach to stave off what could be a difficult period in our domestic economy. So what we'd like to do is have companies that will generate earnings that will, one, benefit from the weaker dollar, and then also enable them to grow their earnings at a stable, better than average pace.
Let me turn you over to our Cosmopolitan International panel, starting with Monte Gordon.
Okay. Alan, on the basis, you mentioned a number of factors which you thought were beginning to work out now as far as the economy is concerned. One of them being presumably a reduction of interest rates that is developing here. Is there any investment strategy or any investment pattern that you would undertake in anticipation of that happening or as a result of it?
Well, one strategy that would certainly make sense, I believe, if rates are going to come down is probably to increase the weighting in the utility area. The utility stocks will certainly benefit from a lower interest rate scenario. So we've used names like Detroit Edison, General Public Utilities. But the group has done very well. That sector's done well and could be subject to some profit-taking in the near term.
Alan, you mentioned a number of very fast-running growth stocks that you're buying. But when do you sell them? I mean, what criteria or factors would you use to say the Compaq, which you're now buying, should be sold? I mean, it's either reached the top or something has happened that's disappointing. I mean, what are your factors?
Well, Frank, just like in formulating the buy process, we look at both the quantitative and the fundamental. When we're trying to formulate the sell decision, we look at those 2 factors as well, but we also establish price objectives for the companies that we invest in. If a company meets or exceeds our price objective, then it could possibly be sold. But also, if the fundamentals deteriorate, we feel as though that's part of the role of the manager to constantly watch the situation. But if we have any of those 3 characteristics, then we look to sell.
Alan, I know you've avoided stocks with a lot of debt, but as interest rates come down, perhaps some of them might do better than expected. Are there any companies at the margin that might do well that have a rather hefty balance sheet?
Not really. One of the, well, not in our universe. Our universe is about 125 companies. We tend to screen for companies with debt to cap of less than 60%. Offhand, I can't think of any that would meet that criteria. Most of them have little or no debt, like a Compaq, for example.
Alan, we only have a minute or so left. I mentioned that your mother started you off right, got you interested in stocks at an early age. And you're a pretty good numbers cruncher now, but I understand you also turn to other members of your family occasionally. Would you tell us something about that?
Well, it's interesting that you mentioned that. My rule of thumb is that I never buy a drug stock without talking to my wife about it first.
Does she take a lot of drugs? What's the connection?
No, that's certainly not the connection. My wife is a physician, and as a matter of fact, she's a surgeon, and so my rule of thumb is that I won't buy a drug stock without talking to her about it first, and her number 1 pick happens to be Merck. She believes that their distribution network is far superior to some of the other competitors, but she also likes Syntex as well.
Oh, so you're able to go home for dinner after recommending Syntex. I'm glad to hear that. And also, I did mention, and I think it's important, this idea that of education for kids. What are you doing there? Can you tell us in a nutshell?
Well, it really draws back to how I got my start and my interest in stocks. What we do is we have 60 school children that compete over a 3-month period. They each create a portfolio within their class. We track it over 6 months. They're brought down to the New York Stock Exchange, and they spend some time and hopefully learn a little bit about investing and about economics.
It sounds like a great program.